an original MCM production.
Today I have the privilege of introducing Baird's Chief Investment Strategist, Bruce Bittles. Mr. Bittles' visit couldn't be more timely given the tumultuous start to this year. I think we've all felt a little bit of pain at the beginning here. And I'm sure he's going to chart a very clear path, investment path for us to follow for the remainder of 2016, or at least give us a little bit of insight. Mr. Bittles provides strategic, economic, and market analysis to Baird's retail, institutional, and corporate clients. He serves as chair for Baird's Investment Policy Committee, is also a member of the firm's Stock Selection Committee. He is the publisher of the Investment Strategy Outlook and the Bittles Market Notes. Also, he is a frequent contributor to national media outlets. Bruce joined Baird in 2002 and previously served as partner in charge of market strategy at J.C. Bradford & Company from 1985 until Bradford's acquisition by Payne Weber in 2000. Prior to joining Bradford in 1974, he served for 9 years as head trader at the options trading firm of Thomas Hobb & Botts in New York City. Bittles earned a bachelor's degree in business and an MBA in economics and finance from Fairleigh Dickinson University. So with that, please welcome Bruce Bittles.
Well, thank you, Stacy, and it's nice to be back at the Rotary. I think I spoke here a couple of years ago, and the crowd was just as large as it is today. I have to say, I thought there was a possibility, since there was very little going on in the financial markets these days, that you might consider another speaker today. The market started the year out certainly in a negative fashion, and actually this is the third year in a row the market's been down in January. That's pretty rare. If you go back in history, you'll find that the strongest months of the year for stocks are typically November, December, and January, and that's not been the case the last several years, and certainly not the case this year. We've experienced a lot of volatility since day one, since January 4th. A lot of it associated with the turmoil in China and what's happening in the energy markets, particularly what's going on in crude oil. Prior to this year, there was almost no correlation at all between crude oil and the S&P 500. In the past 20 days, there's been a 97% correlation between what's happening in the oil pits and what's happening with the stock market. I think at some point in time that'll shift, and it'll probably be a surprise to investors. My guess would be that oil might at some point continue to fall and stocks not. And that would be your clue that the stock market's on pretty firm ground. So that's something you might want to look out for. China, I think China certainly is in a process of slowing down. But I think the thought that they are now a liability to the global economy, I think, is overstated. Just 5 or 7 years ago, China's economic base was much, much smaller than it is today, and that's when they were growing at double digits. Now they're growing at single digits, but from a very larger economic base. So I think their significance now to the contribution to the global economy is still about the same as it was, and the fact that they're still growing, I think, supports the likelihood that the global economy will avoid recession this year. I want to talk to you about some of the things that are going to influence the markets this year. Certainly, the Federal Reserve Board will have an impact on not only the stock market, but the economy as well. There's a lot of concern that the U.S. might fall into recession, and that's the reason why the markets are misbehaving. And I think there's a possibility we may see some inflation surprises somewhere down the road. There's also some headwinds for the stock market this year, and they would include valuations that are stretched. Investors are pretty fully invested after a 6-year bull market, so there's not a whole lot of cash on the sidelines to support a new leg up yet. And falling commodity prices, I like to watch commodity prices because what they do is they give you a sense of the health of the global economy, and they represent demand. And when commodity prices are falling, it makes the global economy suspect. And the commodity index now are as low as they were in the year 2000, so they're at their worst levels in 15 or 16 years. And of course, that's a concern. And then my pet concern for the past 20 years has been excessive debt throughout the economy. You would want to talk about a lot of that as well. What I want to make you aware of, that there's going to be a lot of noise coming from the media this year due to the election and of course, other things that are going on geopolitically. I would try to filter all of those out as best as I could. There's a typical rule of thumb that what everybody knows is not worth knowing. So when you tune into your local business station at night and they're talking about consumer confidence or the economy or what ISIS is doing or who's electable and who's not, I would filter all of that out. It's not pertinent to a long-term investor's perspective. The Federal Reserve Board, what you're looking at here is what they call the famous dots. There are 17 members of the Federal Reserve Board, and they each get an equal vote on where they think interest rates will be a year, 3 years, 5 years down the road. And the consensus estimate now is that interest rates will be 100 basis points higher at this time next year. I think that is unlikely. But I think the Federal Reserve Board will continue to raise rates at a very slow, measured pace this year, maybe one, maybe two more increases at most. The chart you're looking at here shows the relationship between what the Fed does, whether they're aggressive or they're not aggressive. When the Fed is aggressive in raising rates, that means they're raising rapidly almost at every meeting every month. The Fed meets 8 times a year. And when that happens, the markets typically are in jeopardy. The Fed then is considered hostile toward the markets. And there's another rule of thumb: you don't want to fight the Fed as an investor because the Fed always gets their way. But when the Fed is increasing rates at a gradual, measured pace, the markets typically continue on a bullish path, and so does the economy. And from our perspective, that is what's going to take place this year. There's been a lot of concern that the Fed made a big, big error in December by raising rates. I think they could have raised rates much earlier. The chart you're looking at is of commodity prices. They could have raised rates in 2012 when commodities were roaring, in 2013 when the stock market was roaring. The real estate market was recovering, and yet they chose to pass. And they waited until the stock market was on the defensive, commodity prices were cracking, and then they raised rates. So from that perspective, it doesn't make a whole lot of sense. But I'll go forward and give the Fed some credit as we move on here, because I think they too see perhaps some inflationary pressures later on this year. And if that is the case, then the Fed probably did the right thing. The chart you're looking at here simply says that the economy is doing in the U.S. better than most analysts give it credit for. Yes, we're not growing at a great speed level. This is the slowest economic recovery in the nation's history. Since 2010, we've grown about 2% every year, and that's about it. Typically, when you come out of a recession, you just roar out of it, and the economy jumps 7-8% in terms of GDP the first year. The second year, 5 or 6%. That didn't happen this go around. And I think there's a number of reasons for that, but I think the principal reason is we had a very tight-fisted fiscal policy where the federal government hoped that the Federal Reserve Board could do all the heavy lifting by lowering rates to zero and maintaining quantitative easing. And yet, I think the economy was held back by fiscal measures, including taxes. Taxes grew 9% last year in an economy that's growing just 2%. We also know that regulations are hurting small and medium-sized businesses. So we need some help from the fiscal side. Typically, when you have secular problems like we have, such as the middle-class income not growing for the past 10 years, that cannot be helped with monetary policy. It has to be done with fiscal policy. The economy did weaken late last year. As a matter of fact, activity really fell off the cliff in December. Both retail sales, construction spending, automobile sales, everything kind of died late last year, which maybe led to the market fall off in January. A lot of people thinking that perhaps the economy will underperform again this first quarter like it has the previous 2 years. I think it's premature to say that. My guess is the economy did fall off in the fourth quarter last year. GDP growth will probably be less than 1% for the period, but I don't think it'll carry forward as dramatically as it did in 2015 and 14. The problem with the economy is that it's too faceted. One side is weak, one side is pretty strong. The weak side, of course, is industrial production. And if you look at the latest numbers from the Institute of Supply Management that looks at manufacturing activity, you'll find that it's trading about, the last number was around 46. Anything below 50 means a recession. So in the manufacturing sector, and even our friends at Fastenal told us that most of their clients have reduced orders in the last 6 months and that they see very little increase in economic activity. Pretty reliable indicator that that part of the economy is indeed in jeopardy. And I think a lot of that relates to the fact that we have not had the vibrant capital spending in this cycle that we had in previous expansions. Instead of investing in new plant and equipment, a lot of companies are indeed putting their money to work by buying their own common stock back. And that works great for stockholders over the short term. But over the long term, it's a negative in that they get behind the curve in terms of productivity, and it certainly is a negative influence on the economy. But I think that is really why the industrial sector has suffered here. At the same time, the service sector is pretty vibrant. Sales continue pretty strong. Consumer activity is pretty strong, not at the level you consider booming, but certainly strong enough to support the economy. And the service sector is 80% of the U.S. economy. So we've got a weak industrial sector that represents about 20% or less of the economy, and a strong service sector that represents 80% of the economy. That's balanced off, and it has resulted in 2% GDP growth. And we've had that every year now for the past 6 or 7 years, 2%, that's it. Now, there's something changing on the horizon that I think the Fed is looking at that probably prompted them to go ahead and raise interest rates in December. We have had no wage growth in the U.S. for about 10 years. And yet the latest data on the labor markets show that they're pretty strong. We had 280-some-odd thousand new jobs in December. Now, there's a lot of controversy between the numbers and what is actually happening on the ground. But in my opinion, the labor markets are pretty strong. We have 5.5 million job openings in the U.S. today. That is a record. We've never had a number like that. They can't be filled. And they can't be filled because we have not prepared the labor force with the proper education to do that. It's not because of lack of demand from employers, it's because we have a lack of qualified employees. But finally, we're starting to see some wage pressure. And you can't grow the economy if household income is flat. There's just no way to do that. But if income begins to rise at the household level, then all of a sudden you'll start to see more spending. And I think those are the numbers that the Fed was looking at, and they said, wait a second, there is some inflation in the economy after all. First of all, healthcare costs have gone through the roof. Shelter costs, rents are rising dramatically. Those are two huge costs for the average household. And I think they are the reason why we haven't seen the type of consumer spending despite the fall in gasoline prices that we might have expected. I still think the fall in gasoline prices is very real, and I think at some point down the road they'll pay a lot of dividends. Right now, the fall in oil has created a lot of instability. And I think a lot of that relates to the fact that a lot of marginal companies that were drilling or fracking have taken out a lot of debt. And that debt, of course, is vulnerable to default. I think that's what's hurting the markets right now, that worry. But the fall in oil prices by 70% over the last few years is a boom for consumers. For the global consumer, it represents an $8 billion tax cut every day and almost $3 trillion over the course of a year that goes into their pockets. I drive an SUV with a diesel, and I filled up before I left town, and it cost me $35. I mean, it cost me $80 about a year ago. And you multiply that times millions and millions and millions of vehicles, I think eventually that'll overflow into the economy. I think the prospects of a recession in the U.S. are very, very low, despite what's happening in the financial markets. Like I said, the service sector is pretty strong, the job market is pretty strong, and we see no signs of recession elsewhere outside of manufacturing. And I would think that there's a lot of pent-up demand for capital spending. And I think that will be unleashed in the next year or two if we get a very friendly administration toward business. Whether it be a Democrat or a Republican, it doesn't matter. This is from an economic perspective. If we get some tax relief, if we get some regulation relief, and we get some reforms in education, I think the economy could boom in the next couple of years. There are still headwinds for stocks, however, this year, and we pointed a lot of those out in a publication we printed in December, which was our outlook for 2016. We felt that one of the headwinds was valuations were stretched. Now that's a carry forward from 2015. When we entered January of 2015, we felt stocks were richly valued, and therefore that represented a headwind for stocks in 15. And that's exactly what happened. As you know, returns were very small. And the same thing exists in 2016. We had a correction in August and September that carried the averages down about 12%, but earnings also fell. So we had no really relief from the valuation perspective. The breadth of the market or the broad market continues to deteriorate, and we'll talk about all of these in a little bit more detail. Liquidity is low, and I think the reason for that is most investors after a 6-year bull market are pretty fully invested. There's not a whole lot more to come in from that area. And once again, debt is excessive and it's global. But on the same token, profit margins for corporations are high. You saw today a lot of corporations beating estimates. I think you'll see more of that as we go on. A lot of the earning power is being lost in the energy sector, of course. and that's what's really influencing the overall S&P earnings. But valuations are a concern to me. This chart shows that the median price-earning ratio on the S&P is about 22. That's the median. That means that 50% of the companies in the S&P are even trading higher than that. And when you have excessive valuations, it creates two scenarios. One, it opens the market to an outside shock. And that's exactly what happened in January, in my opinion. Stocks were fully valued, and all of a sudden, oil plunged, and China came on with negative news, and the markets couldn't absorb all of that. If a market is undervalued or just fairly valued, you don't have those same kind of reactions. And two, when valuations are stretched, what that means is that over time, it depresses returns, just as you would expect for any asset class, whether you bought a home or you invest in gold or you invest in a stock market. If you're buying an asset that's fully valued, your future returns will be less than if you buy an asset that is certainly undervalued. Those folks that were bright enough to buy stocks in 2009 were greatly rewarded. The S&P was trading at 11 times earnings, and they made a lot of money. When you're buying something that's less attractive, your returns tend to be smaller. Profit margins remain high. That's good and bad. It's bad in the sense that if profit margins get squeezed for one reason or another, thank you, one reason or another, then earnings will be suspect again. But I think earnings will hold up this year. I think they'll be up about 10% of what we saw over last year. The consensus estimate are that earnings will be up 19% in 2016. Consensus was wrong in 2014, 15. I think they'll be wrong again this year. I think it'll be up about 10%. Investor sentiment. Just like all of us in this room today, a lot of us are pretty concerned about what's happening in the market in January. I mean, we've had a steep correction this month. And the good news is that a lot of investors have turned very cautious and, in a lot of cases, extremely pessimistic. Now, I believe that a lot of the performance in the equity markets are based on investor psychology alone, that it really has very little to do with earnings, very little to do with geopolitical situation, and very little to do with who's president. It's a psychological factor, and therefore we track investor psychology the best way we can. And we use it as a contrary opinion indicator. And the reason we do that is because there's an inverse relationship between investor sentiment and liquidity. When everyone is bullish to the extreme, it means their money is already in the market and there's no more money to come in. And that's why the top of the market is always the point of maximum optimism. And the same occurs at a bottom. People become fearful. They begin to lighten up on their stock market positions. They continue to do that for a considerable period of time. And before you know it, you're at a point of maximum pessimism. And you'll always find that at all important market bottoms. In March of '09, at the bottom, at 666 on the S&P 500, it was a Thursday, and I was in my car on the way to the dentist. Now, the markets were cracking, and I'm going to the dentist. Not exactly a day you'd all want to hold. Anyway, I got a call from my associate in Milwaukee, and he told me, Bruce, did you see the latest numbers from the American Association of Individual Investors? I said, no, I've been in the car. He says, well, there are more bears in that survey this week than any time in history. That was the bottom day. The market turned around that afternoon and never looked back. And we've got a whole tree of indicators that talk about investor psychology, and we try to measure that because it's very important. And right now, as of last week, investor pessimism was about as thick as it gets. And that led me to believe that at least we might be seeing a short-term bottom in the markets. That's to be seen, but we find this very, very helpful, and I pay a lot of attention to investor psychology. There's been a lot of volatility in the market this year. Last year we had a correction that carried 12% from top to bottom, and everybody thought that was terrible. That was less than normal. If you go back 50 years, normally a market will have a 15% swing from top to bottom. That would be normal. In a market that's really volatile, it would be twice that. So we felt that last year was probably close to a normal volatility year, but that 2016 volatility would increase for two reasons. One, typically volatility does increase when the Fed is in the process of raising rates. And two, the market's more volatile in a year when we have a presidential election. So for those two reasons, we felt and warned investors late in December that be prepared, 2016 is going to be a lot more volatile than we're used to. We got spoiled. In 2012, 13, and 14, we didn't even have a 5% correction in the market, nothing. I mean, the markets went straight up with no volatility at all. So we felt that that was the norm, but believe me, that is far from the norm. What we're entering now is more normal territory. I am concerned about long-term sentiment numbers, however, because a lot of folks have been forced into the market that really probably shouldn't be there. And they've been forced into the market by the Federal Reserve Board that lowered interest rates to zero. And I'm afraid a lot of folks are using the stock market as a bond equivalent. It's not a bond equivalent. So you have to be very careful with your asset allocation depending on your risk tolerance, but most importantly, based upon your age and how you can recover to certain situations. My opinion is for the average investor in this environment, in an unstable world, 55% allocation for stocks is about right. 30% bonds and 15% cash. That would be a normal allocation for someone in their 50s with financial resources. If you're much older than that, I think you have to reconsider what you really want to do and what the risks are in this market. I've been doing this for a very long time, and I've never met anyone that could forecast the future. And I certainly can't do that either. But I try to manage risk for our accounts. And in the current environment, I see the risks above normal and volatility above normal. So I think you have to take actions as a result of that. And like I said, for the average investor, 55% allocation towards stocks is about right. Debt in the markets has really hurt the economy in a lot of regards. The biggest question I get is why hasn't 0% interest rates and 3 episodes of quantitative easing allowed this economy to expand above 2%? What has happened here? I think you just have to go back and look at the debt situation in the U.S. The chart you're looking at, the top clip, is the rate of growth in the U.S., and it peaked in the 1980s, just about the time that the debt expansion began to explode. Now, politicians will always ask the consumer to go out and borrow money to purchase goods to reinforce the economy during harsh times, hence cash for clunkers. That never works. The only thing that works, the only way you can build an economy is encouraging savings and investment. Now, economists will tell you, oh, no, that doesn't work because when you save more, you spend less, and it hurts the economy. And that's exactly right. But over the long term, it builds up tremendous pent-up demand for consumer goods. And the stock market always does better in a period where spending is below savings. In other words, savings is strong. The stock market tends to go up Business formations tend to go up. When you borrow money to buy anything, it takes away from the future. And when you have excessive levels of debt in any economy, any household, any corporation, that debt saps all the energy out of that enterprise. And in my opinion, that's why the economy has not done very well, despite 0% rates and free money. Same thing is happening in Canada and elsewhere. The top clip is their rate of growth. The bottom clip is their growth in debt. And the same thing is in China. All of a sudden, China's rate of growth has slowed, but their debt has exploded. And that takes away from future consumption. Why do we look at seasonal patterns in the markets? Because the market tends to go in cycles. And we present a chart like this every year that we use as kind of a roadmap of how we might think the market will react in the coming year. And we use the 1-year cycle, the 5-year cycle, 4-year cycle, and the 10-year cycle. Now that sounds very confusing, doesn't it? But it's actually pretty simple. The 10-year cycle is probably the hardest one to figure. And that says the market does best at years ending in 5, and that's about it. The 4-year cycle says the market tends to do best in the 3rd and 4th year of the presidency. And the 1-year cycle you're all familiar with, I know, it says the market tends to do best from November 1st to April 30th, and then do poorly from May 1st to October 31st, hence the phrase, sell in May and go away. Well, we put all 3 of those together in a chart every year in December for the upcoming year, and it looks just like this. And my gut feeling is, at the end of the day, it'll probably look about like that when 2016 ends. I suspect you'll find some increased volatility in the 2nd and 3rd quarters. And my guess is the market will rally in the last quarter of the year, maybe pretty good. The market tends to go up after a presidential election regardless of who wins. So that's the cycle we would be looking for. And the final problem in the market that I see right now that needs to be corrected before we can really get aggressive and suggest investors invest more than 55% of their money in stocks, and that is market breadth. That's what's going on below the surface outside of the popular averages. In a healthy bull market, one where you don't have to worry, everything is going in the same direction. Big stocks, small stocks, value stocks, growth stocks, foreign stocks. Everything is going in the same direction in a healthy market. In a market that is vulnerable, suspect, and looking for trouble, you have some stocks going up, some stocks going down, and that market typically ends up going down. And that's what's happened in the last year. If you look at 2014, 13, 95% of all the industry groups, the red line represents the industry groups within the S&P 500. The blue line is the S&P 500 itself. There are 100 industry groups within the S&P 500. In a healthy bull market, you'll see 85, 90% of those industry groups all in uptrends. And in a market that's less than healthy, you'll find divergences where the number of industry groups start to dwindle. In other words, the number of stocks participating in rallies becomes smaller, and that's what happened last year. The S&P 500 closed about flat for last year, but there were 301 stocks within that index that closed down 10% or more. 175 stocks within that 301 closed down 20%. So the index itself was deceptive of how well the markets did last year. So when we bring all these together, I said we don't do forecasting, but I do look at the 6 most important elements of the stock market. And they are Federal Reserve policy, the economy we talked about, valuations we talked about, investor sentiment, seasonal influences, and finally the tape or the breadth of the market. We simply add them up and they give us our investment attitude toward the markets. And right now, I think the Federal Reserve Board is certainly less friendly than it was in 2014, 13, 12, and 11. They have let QE3 expire, and they're beginning to raise rates. So I think their influence on the markets now, I don't think they're hostile, but I think they're just neutral. The economy is still bullish. And you say, how can the economy still be bullish, only growing 2%? And that's because the stock market always does best in a slow growth economy. A slow growth economy does not produce any inflation, and it doesn't put pressure on rates. And the money doesn't go into the economy, it goes into the stock market. So the economy is bullish right now for the stock market. Valuations, I think, are excessive, and that's bearish. Now let me tell you one thing about valuations. They do not tell you the direction of the stock market. Stocks can stay overvalued, undervalued for long periods of time. They're not a good indicator to use to try to guess the direction of the market. What they do tell you is something about the risk in the market, and they tell you something about investor sentiment. When someone's willing to pay up for an asset, that means optimism. And we talked about optimism and pessimism. Seasonal influences right now remain favorable. The tape remains unfavorable. I would think the most important indicator to follow going forward would be the tape. If the broad market starts to improve here, and improve significantly, I think it would suggest that a new leg of the bull market is underway. Until that happens, I think you have to be cautious. The bottom line is this. The feeling of volatility in 2015 was just a prelude to what we're seeing in 2016. The Fed tightening doesn't mean that the economy and the stock market will do poorly if they continue to go slowly. Excessive valuations, I still think, will limit returns. And the presidential election tends to be pretty noisy. And I think I would tune that out as best I could. The trends continue to be, in my opinion, as investors, I would want most of my assets in U.S. securities. Investors always do best in their own backyard. And given the instability in the global markets and the global economy, I think the U.S. is still a place to be with most of your equity investments. Small caps we liked at the beginning of the year, they underperformed. My guess is that large cap value stocks will likely do best in 2016. The sector leadership, if the market remains healthy, will be consumer discretionary, technology, and the dark horse would be industrials if the market sniffs out the possibility that we're going to have some very strong fiscal reforms. And I think worrying about volatility and raising some cash in the market is probably the right thing to do, particularly if you don't have any cash at all. The media always says cash is trash because it doesn't return anything, and that's true. But what cash does, it adds to your stability of your portfolio by reducing the risk, and it provides the liquidity to buy when valuations become attractive. And that's why you'd want to have about 15% cash. And that concludes our presentation today. Yes, sir.
What do you see the dollar doing next year, this year?
Yeah, that's a good question. What do I see the dollar doing this year? Well, the dollar's been really a headwind for stocks, earnings, and the economy. When the dollar is rising, it's a deflationary influence, number one. Number two, it hurts corporate earnings for those companies dealing overseas. When they bring back those profits and they translate them back into dollars, they get hurt. And that's been a factor this year. Also, it makes our goods less competitive with foreign goods when we try to export overseas. So the strong dollar has been a headwind, and that's why it's a good question. I suspect the dollar is going to stabilize this year. And last year we had a big rally in the dollar. I think it'll probably go nowhere this year. And that's important for this reason. If earnings are going to improve, and I think they're going to because earnings will have easier comparisons in 2016 from 15. And if we just have a stable dollar, that'll be really beneficial to our global corporations. So it's a good question. Yeah, the question is, when we look at debt, how do you categorize it and how do you look at it in terms of where it is? Now, the good news is consumer debt's been coming down, and that's healthy, but it hasn't come down enough to really feel that it's at a level that could really spark a new leg up in the economy. But the fact that it's been reduced, I think what happened in 2008 and 9, I think that housing crash got a lot of folks' attention, particularly those that were overextended in debt. And for that reason, I think that was healthy in that regard. So, but governments and corporations have continued to borrow through this whole cycle and have taken debt to new levels. So I still think debt overall is a problem. Short selling is the question, and do I recommend it or should it be used? And I suggest you don't do that. Short selling is selling something you don't own in the hopes of buying it back at a lower price and therefore capturing that profit. And I don't recommend you doing it for a couple of reasons. One, it takes your focus away from your long-term goals. And if you have 2% or 5% short position in your portfolios, that's the only thing you'll be following, I guarantee it. So I suggest you stay away from that and leave that to others. Thank you.
An MCM production.